welcome to everybody. Thank you so much for joining us on our webinar series, Estate Planning Simplified. I think you'll agree with me by the end of this that it's been well worth your while. I've learned already so very much from Candice and Vlad, who've been stellar in providing their expertise to us, for us and for you. This is hosted by Wildlands League, and I'm Janet Sumner. I'm the Executive Director at Wildlands League, and Jennifer Burney is our donor specialist, and she's here in support of the webinar and making sure all the bells and whistles work in behind the scenes. And maybe, Jen, you could give everybody the housekeeping rules so that they all know how to participate in the best way possible.
Thank you, Janet, and welcome everyone. First off, your video and microphone should be muted just to help us maintain a good bandwidth during the webinar. If you notice any of the presenters' faces are covering the presentation, you can adjust that in your personal settings, and you can use your control panel to change the view. You can use the Q&A button at the bottom of your screen to submit any questions that might come up during the presentation, and I'll be monitoring them. So we'll try to fit them as we go along, but we'll also have a Q&A session at the end. And after the webinar, you'll receive an email with a link to register for our next and final webinar in the Estate Planning Simplified series, which is being held October 20th on will and estate pitfalls. Thanks again for joining us, and I'll pass it back to Janet.
Okay, thanks, Jen. So now I'm going to introduce our two presenters, who we are very fortunate to have with us. First up is Candice J. Candice has over 15 years of experience in the financial industry and has her own practice under CCNL Private Capital. Prior to joining CCNL Private Capital, she was at Pembroke Private Wealth Management and HSBC Global Asset Management. Her practice guides and works with charitable foundations and high net worth clients with a focus on women, entrepreneurs, and families to achieve their long-term financial goals. Strategic philanthropy is also an important part of Candice's practice, and she is passionate in working with clients to identify values and areas where philanthropy can play a role. Obviously, I'm stumbling over a few words today. She holds the Chartered Investment Manager, CIM designation, is a fellow of the Canadian Securities Institute, and was awarded the Master Financial Advisor of Philanthropy designation in 2020. Candice understands the importance of giving back to her community, and she is a current board member of the University of Toronto Alumni Association and UHN Impact Collective of the Toronto General and Western Hospital Foundation. She is also a member of the Canadian Association of Gift Planners, leading engagement and mentorship for professional advisors in the GTA chapter. In her spare time, if she has any, I'm assuming, Candice enjoys practicing yoga, playing golf and tennis, and taking hikes with her family golden retriever, Sadie. Aw, little Sadie. And then we also have Vlad Solokhine. He is a certified financial planner with over 15 years of experience in the financial services industry. He is currently a team member of the Lazar-Wealth Succession Strategies, a financial planning boutique in Markham, Ontario. Before starting his own financial planning practice in 2012, he had the privilege to work in a major Canadian bank, an insurance company, and a mutual funds company in advisory and senior management roles. In his practice, Vlad specializes in philanthropy-focused financial planning, helping people with disabilities and people in career transition. He is the chairman of the board of High Notes Avante, the registered charity that inspires people touched by mental illness through artistic expression. Vlad is also a member of the Professional Advisor Committee of the Canadian Association of Gift Planners. Vlad lives in Markham and in his spare time enjoys family activities with his wife and 3 children. An interesting fact that I personally really find very interesting is that Vlad has a bachelor's degree in physics. So you can see we have 2 very skilled people in gift planning and thinking about estate planning. So I'm going to turn it over to the 2 of you to begin the presentation. Thank you so much.
Thank you so much, Janet and Jennifer, and good afternoon, everyone. Jennifer, if you don't mind putting the slides forward. And following along from our first session, we are excited to continue to present the second of our 3 seminar series on estate planning simplified, considerations beyond the will. And today we will focus on estate bypass and equalization, which will be presented by Vlad. I wanted to start off with one of the statistics I mentioned in the last session, which was that 85% of Canadians donate to charities, but only 20% of them claim the donation tax credit on their personal income tax returns. On the next slide, on this slide, we can see this more clearly in the chart of trends in individual giving from the mid-80s to 2014, which is the most recent study done by Imagine Canada. The orange line is represented by the donor rate, and the dotted black line is the average donation. This period can be divided into 4 phases. Phase 1, from the mid-80s to 1990, shows rapid growth. Total donations increased by 24%. There was an increase in the number of tax filers claiming donations, even though amounts claimed decreased. Phase 2, 1990 to mid-90s, it shows a stagnation in donations. Claimed donations only increased 2% over the entire period, and the donor rate dropped significantly. Phase 3, mid-90s to 2007, shows even more rapid growth in the average donation. Total claimed donations reached its peak of $9.6 billion just prior to the economic downturn of 2008. And Phase 4, 2007 to 2014, it shows fluctuations in annual donations. Only in 2014 did claimed donations return back to 2007 levels. The overall trend here shows that the donor base is getting smaller, and changes in total donations are now primarily driven by how much donors are giving. From the peak in the 1990s, the percentage of tax filers claiming donations has dropped roughly by 1/3, while the average amount claimed has nearly doubled. This means that charities are relying on a smaller number of people for donations, but beyond that, Canadians are not taking advantage of their donation tax credits, and financial advisors need to work more with donors to find efficient philanthropic strategies to maximize Canadian donors' donations. The next slide focuses on the online giving index during January 2017 to December 2019. And using Canada Helps data, the online giving index measures 36 months of growth in online charitable giving. A value of 100 means that the particular period grew at the same rate as the baseline of 2017. This happens to be capturing a period of time when Canadians responded quite generously to many philanthropic calls, such as the appeals for people fleeing unrest in Syria and those affected by the earthquake in Ecuador, and for Canadians displaced by the 2016 wildfires in Alberta. An online giving index above 100 means that this period grew at a higher rate than the baseline of 2017. And any value below 100 means slower growth. When the line is sloping downward, these are periods of slower growth for online giving, and an upward sloping for period for faster growth of online giving. And you can see that there is a huge spike in growth in December 2019 on the right-hand side of the chart, and probably continues to go up now as many people are giving online to help out during the COVID-19 pandemic. On the next slide, we take a closer look at the month of December in 2019, which includes Giving Tuesday data. We see that 8 out of 10 charitable categories had online giving index values above the baseline of 100. And 2 categories, education, represented by the yellow bar, and environment in the bright green bar, were the only ones with slower growth in December 2019. But luckily, we are seeing a reversing trend, and donations in the environment category seem to be in a state of accelerated growth in the US and in Canada as climate change is in the forefront and became a federal election issue. I will now pass the presentation to Vlad to go over some financial planning strategies and concepts of estate bypass and equalization. Please ask your questions in the chat box as they come up, and we will try to get to all of them in the Q&A portion of the webinar. Over to you, Vlad.
Thank you, Candice. Well, it's interesting to see those trends in philanthropy, and the part of the reason why the average value of an individual donation increased over time is the fact that people started donating more and more through their estates. Of course, this process is challenging. You have your family, children, grandchildren, so on, and finding the place for your charity might not be that easy. For that reason, I didn't even include the arrow named charity on this slide, but unfortunately, I had to include arrow that says lost, because it happens to some degree in almost every estate. Well, you might ask, what exactly is this lost arrow? Well, it is what it looks like. It's lost assets. Estate distribution is a complicated process. There are different parties that are involved in it: close relatives, distant relatives, ex-spouses, lawyers, CRA, financial institutions that hold different assets and mortgages, probate court, funeral home, and believe me, many, many others. And when people are focused on too many things and faced with tight deadlines, there is always a chance to make a mistake and miss something. That is why the whole idea of this webinar series is to simplify your estate transfer process so that you could leave better prepared and start making some actions now before all involved parties start acting all at once, being pressed by deadlines. We are not going to talk much about the lost arrow now, but we're going to focus on what we could do to make sure that that little dark arrow does not become too wide and too long. So if we look at the slide, it shows us that even if we have $1 million and perfectly drafted will, it does not anyhow mean that beneficiaries will receive $1 million. The amount of money actually received by the beneficiaries is quite often reduced by terminal tax return that might be taxed at 50% or more, as we discussed in our previous webinar. The probate fees. For some reason, Ontario probate fees are the highest in the country. Legal fees, some other fees that may come up with financial institutions or property registration offices, and so on. And don't get me wrong, those fees are not designed for nothing. They facilitate proper and legally clean distribution of the estate. However, nobody needs to pay more fees and taxes than necessary. That is why today we're going to focus on the estate bypass. If we could click on the slide, please. In other words, we're going to focus on the way to transfer the assets to beneficiaries directly without going through the estate. Now, let's move on to the next slide. You could see that there are a few ways to bypass the estate. For example, the last line, holding assets in joint ownership is a very well-known and widely used way of achieving just that. However, the courts and the CRA keep imposing limitations on this method. And if you're interested in all pros and cons of joint ownership, I suggest that the best person to talk for you would be your lawyer. I would like to focus today on less common but still highly effective ways to bypass the estate fees, and they are segregated funds and life insurance. We already talked about assigning beneficiaries to the registered plans in our first webinar, and how effective it could be if you make your spouse a primary beneficiary and your charity a secondary or contingent beneficiary. I just want to emphasize that sometimes some financial institutions, not all, but some of them, are reluctant to even give you an option to assign a contingent beneficiary. Hard to tell why it's happening, but it's important to know that it is not the law. It is just their specific in-house business practices. Feel free to shop around. There are plenty of respectable financial institutions in Canada that will be happy to hold your RIF and allow you to designate a contingent beneficiary. Now, let's move on to segregated funds on the next slide. Well, segregated funds are very similar to other investment funds that you might be familiar with, such as mutual funds and ETFs. They are investment vehicles that allow people to participate in the market growth of a large investment fund that has dozens or sometimes even hundreds of individual entries. What makes segregated funds unique is their insurance nature. Legally, a segregated fund is an insurance contract. And that means that they have few features that could be extremely helpful in the estate transfer process. And those features are not available in more conventional funds. Let's examine them in more detail on the next slide. Well, the first feature that I would like to discuss is the death guarantee of the invested principal. And this feature addresses the most common fear that I hear from older clients that invest money with me. One of them even told me, Vlad, listen, I'm too old to buy green bananas, and you're telling me to start invest now? Yes, I don't really need this money, but I want my children to get it. And what if the market crashes when I die? Well, death principal guarantee takes care of that problem. As a customer, you may select 100% principal guarantee and your principal will always be protected. With some insurance companies, you can even select reset this guarantee once a year to take advantage of the increased market value in times of good market performance. The next feature is somewhat similar, and it's called maturity principal guarantee. It is not as widely applicable as death guarantee because these days insurance companies tend to assign maturity to their contract, say to a client age of 100 or even 105. Well, frankly speaking, not everybody gets to live to that age. However, there is one very useful exception that relates to the RRSPs. If you open the RRSP account with the insurance company and invest in segregated funds, the maturity date will be the 31st of December of the year in which you turn 71. The reason is simple. By law, at that date, the RRSP must be terminated and rolled over to a RIF, after which you start taking regular withdrawals. It makes the maturity principal guarantee quite useful. If you had to turn your money into a RIF, say in December of 2008, your investments were probably 30% or even deeper down at that point. Getting 100% of your principal in cash at that particular time would be a nice touch. However, if you want this feature, you have to make sure that it is set up to 100% level at the moment when you sign the contract. The standard level of both principal and maturity guarantee is 75%, not 100. And once set, it cannot be changed. Another useful effect that you get with segregated funds is that probate fee is not applicable to them. When the account holder dies, the segregated funds are treated as insurance money. They bypass the estate and are transferred directly to the named beneficiary. The entire balance is not subject to probate. The next benefit of segregated funds is rather unexpected: additional creditor protection. Since they're treated as insurance contract, in many cases, people get to keep their investments in segregated funds even when their assets are taken by their creditor. This feature is especially appealing for the business owners and for anybody else who expects creditor intervention during their lifetime or at the estate stage. Of course, in some cases, this protection might not be granted. For example, if someone deposits just a noticeable amount of money into segregated funds, say 2 months prior to declaring a bankruptcy, well, courts are not going to protect that. But if someone was depositing $100 a month or any regular amount of dollars per month for a number of years, and then becomes bankrupt or dies and creditors seize their assets, in fact, that segregated fund portfolio will bypass the estate, bypass the creditors, and be delivered to a beneficiary. Another particular useful benefit is that there is no time delay. When the account holder dies, the insurance company issues a check to named beneficiaries. It usually takes a week or 10 days, but then the money is delivered. Those of you who already dealt with someone's estate might remember that even if everything is clear and there are no people who legally challenge the will, the actual estate distribution can take 6 months or longer. Of course, if there are legal complications with the estate or with the will, it may take years to clear the money. However, if there was a portfolio invested in segregated funds, it would be delivered to the beneficiaries in a week or two. The estate would be probated as long as it takes. At the same time, the segregated funds portfolio bypasses this problem. The next benefit is related to the fact that the will is a public document. It is open to all those involved with the estate to review and contest. Well, at the end of the day, that's the whole point of the probate procedure. But we remember that segregated funds portfolio does not form the part of the estate. If necessary, it could be passed to a beneficiary in complete privacy. If you want to pass some money to a family member, a friend, or a charity without informing anybody else, segregated funds portfolio could be a solution. The next benefit that I would like to emphasize is that every segregated funds contract always has a named beneficiary. We're all familiar with beneficiaries on registered accounts such as RRSP, RIF, or tax-free savings account. However, the segregated fund is probably the only one solution that allows you to assign a beneficiary to a regular non-registered account. That goes hand in hand with previous benefit of privacy. You could set aside a special portfolio, name a special beneficiary or a charity, and this information will not be shared with anybody. Or if you simply want to avoid the probate altogether, you have only one child and you want to channel all the money to that child without any court involvement. It could be done. You invest your assets in segregated funds, name your child as a beneficiary, mission accomplished. That brings us to the last point. All those features and benefits make the segregated funds the ideal investment vehicle for the estate succession. You can use the portfolio as much as you need during lifetime. There are no restrictions. It works just like any other investment. But because it allows a beneficiary on every account and legally bypasses the estate, you could achieve sizable savings and avoid frustrating time delays. So, are segregated funds the ideal investment vehicle for everybody? Well, of course not. They do have slightly higher management fee to support additional guarantees. However, there are some situations in which the segregated fund would be the best investment. Let's move on to the next slide to find out. Who are they good for? Who would be the ideal segregated funds portfolio holder? Just take a look on those bullet points. And first of all, if you believe that segregated fund guarantees and estate bypass benefits are more important for you than, say, extra 0.5% return per year, you should consider them. If you start thinking seriously about the estate succession, how to structure those gifts properly, consider segregated funds as one of the solutions. The same applies to giving gifts in privacy or avoiding creditors. Segregated funds could be the best investment vehicle in that situation. Well, on this note, I'd like to finish my overview of segregated funds and move on to the next slide to discuss a simple life insurance contract, which is an immensely powerful investment for the estate bypass. What does make life insurance contract unique? By definition, it includes 3 parties in addition to the life insurance company, and they are the owner, the life insured person, and the beneficiary. I'll show you later one example on how to use it to your advantage. Second, life insurance payout is tax-free. Even though permanent life insurance can pay dividends and can grow in value quite substantially over the years, if the payout happens after the death of the life insured, there will be no taxation. And third, the corporately owned life insurance policy creates additional tax-free advantage for the shareholders of the small business. In fact, this advantage is so huge that some people call corporately owned life insurance an offshore on Canadian soil. However, this particular feature is quite heavy from accounting standpoint, and I would prefer covering it in a separate webinar for the business owners and their accountants. For now, we're going to review the regular life insurance benefits that are easily available for everyone. So let's move on to the next slide. Life insurance is designed for the estate transfer. It has always been an estate transfer instrument from the moment of its invention. And there is no surprise that it became very efficient in it. Even in my example here on the screen, a 60-year-old woman can get a permanent life insurance policy with a face value over $100,000 for just $200 a month. There are no stock market risks, no management fees, no legal fees, probate fees, time delays, and of course, there are no taxes. If you decide to donate it, you basically multiply the benefit. your charity receives a sizable gift, and your estate receives a sizable tax receipt to offset extra taxes on family cottage and other liabilities. And you don't have to donate the entire death benefit. You could allocate 15%, 25%, well, any amount basically to your favorite charity, and the rest could go to your family members. Every life insurance contract allows you to have multiple beneficiaries. Some people do not need tax receipt for their estate, but instead they prefer donating life insurance policy in a way that they receive a tax receipt for every premium that they pay for life insurance. And it could easily be achieved. It's just a matter of structuring it properly. There are multiple ways how you could utilize life insurance for your estate transfer. But because we only have a certain amount of time, I would like to highlight a particular use of life insurance, which is called cascading wealth. Let's move on to the next slide. The method of cascading wealth takes full advantage of the complex structure of life insurance that includes 4 separate parties. First, it's life insurance company. Second is the owner. Third is life insurance individual and the beneficiary. Quite often, the owner and the life insured person happen to be the same individual. And that is why, even when people realize how helpful life insurance policy could be for them, they're afraid to try it, simply because their age or stage of health could make premium too high, or a life insurance company could pronounce them uninsurable. In fact, it's a great opportunity to stop for a moment, take a deep breath, and realize that you have the money. You have to transfer it within the family, and you do not have to be a life insured person. You could simply be the owner. If you make your young and healthy adult child a life insured person and your grandchild a beneficiary, you could still achieve a remarkably efficient wealth transfer. Say you buy the policy, make your adult child a life insured, and also designate him as a contingent owner, meaning that your child becomes the owner when you pass away. This way, you keep full ownership over the policy, fund it with your own money in the pace you want it, and when you pass away, your adult child assumes the ownership, and then, and only then, gets full access to cash value of the policy. They can use it to borrow against it from the insurance company. They could make partial surrender of the policy and utilize that money. They could pledge it to the bank as collateral and get a secured credit with very low interest rate. They could also contribute additional money to the policy to make it more valuable for their own children. And the policy keep growing all these years. And when they pass away, the wealth is transferred to their children, meaning your grandchildren, tax-free. There are insurance policies that could be completely paid up in 10, 15, or 20 years. In other words, you buy the policy on your child, you pay it for 15 years, and then the policy doesn't require any more money, but it still continues growing. When you pass away in 25 or 30 years from now, your child assumes the ownership over this asset and no more payments are needed. They could access the cash as we discussed, or they could just let it grow. And eventually when they die, it is passed to the grandchildren, no market risk, no taxes. That is how you could cascade your wealth over 2 generations, even if your age and health stage make you uninsurable. All right, let's move on to the next topic on the next slide, which is estate equalization. And there is a reason why I placed this picture on this slide. You can see a large, beautiful glass orb. The sun shines through it, and well, I don't know about you, I just have a temptation to take it in my hands. And now imagine it happened. It's your ball, you're holding it in your hands, and the main reason why you're holding it, it's because you have to split it into 3 separate parts. It doesn't feel right, does it? And that's exactly the feeling that some people have when they're facing the dilemma of passing their perfectly working business or a large real estate or an expensive piece of art to 2 or 3 children. How can you split this beautiful orb into 3 parts without damaging it? Well, the answer is simple. You cannot do that. You must find another solution. And of course, the situation with the real business could be much more complicated. Let's move on to the next slide. Well, I'm going to use the family business as an example, but the same logic is applicable if we're talking about the piece of art or real estate. So there are some problems here. What if one child just doesn't want to be involved with this piece of business whatsoever? What if one of the children really wants to get their hands on business, but only to support their extravagant spending, only to squeeze some money out of it? What if they just don't care about this business whatsoever? And what if you have a good reason to believe that your children, once they assume ownership, might not be the best business partners? Well, the easiest solution to this type of problem is life insurance policy. One child gets the business and another one or other ones become beneficiaries on life insurance policy. Basically, you as a parent buy your other child or children out, sparing the designated owner from doing so. Of course, other assets of the estate could be carefully gifted through the will to other children to make sure the estate equalization is fair. However, the advantage of life insurance policy is that it could be arranged to any amount to finalize any inequality, large or small, that you don't want to have. If you need to give your other child an extra $1 million just because the value of your business increased so much, you either find that extra $1 million in cash or you increase your insurance premium by a certain amount. And quite often, the second option is much easier to accomplish. Estate equalization is important. It prevents potential legal disputes over your estate and shows to your beneficiaries that you really care. Basically, that's all information that I have for today. And I would like to summarize our presentation by moving to the next slide. Today, we discussed the estate bypass. It is not a silver bullet. It should not be applied to all of your assets in all cases. However, careful use of the estate bypass techniques allows you substantially decrease probate fees, legal fees, and estate distribution delays. There are few ways to achieve the estate bypass, and some of them should be definitely discussed with your lawyer. At the same time, segregated funds and life insurance represent simple and effective ways to achieve just that. And finally, do not ignore the estate equalization. Do not assume that when you are no longer here, your 3 children will be happily running the family restaurant surrounded by their spouses, ex-spouses, and other individuals. In cases like this, additional life insurance policy is worth considering. Overall, the moral of today's story is take the action now. Talk to your lawyer, talk to your accountant and financial planner. Use available solutions before that moment when you're no longer here, and all kinds of people with their own agendas will be acting desperately to divide your money. On this note, I would like to wrap up my presentation and pass it back to Wildlands League for Q&A session.
Thanks so much, Vlad and Candice. We've had some questions come in. The first one is, what if I have a health problem? Could I still own segregated funds?
Oh, yes. Since I mentioned that segregated funds are actually insurance contracts, it's a very legitimate consideration. Well, luckily, no. Even though it is an insurance contract, underwriting is not required, and person at any age, any health can have that 100% guarantee, no problem.
Okay.
Awesome.
So you said segmented funds have higher management fees.
Okay.
So how much worse do they perform compared to regular mutual funds?
Technically, this question should be discussed on case-by-case basis, but I'll try to generalize a little bit here. I had experience working in the wealth management division of the bank, so I will be using bank funds as a benchmark. And when we are assessing the performance of any 2 funds, we have to remember that at the end of the day, for us as customers, we need to get great return after the fees. It doesn't matter what the fee is. It doesn't matter what, say, car dealership earns. What matters is that you get the car at the best price. The same logic applies to all kinds of investment products. So if we start comparing the return of the same categories, say Canadian equity with Canadian equity, or comparing balanced fund with balanced fund among segregated funds and mutual funds, if we take bank funds as a benchmark, I can assure you that there are plenty segregated funds that have higher management fee still performing actually better than those funds. So on case-by-case basis, I would say if you have good analysis, you shouldn't worry about underperformance.
Okay.
So can I just follow that up with a question, Vlad? So I take from what you're saying on that it's a matter of having a good conversation with your financial planner and talking about then what actually is performing and what was performing at what rate to get the best performing fund for you.
Absolutely. And as everywhere, it's not just the performance. If I keep using car analogy, you may have a great engine performance, but if you have huge pickup truck and you own a little parking space in Conda, downtown Toronto, it might not be the best vehicle for you. Mm-hmm. On the other hand, if you're doing landscaping somewhere in suburbs, a large pickup truck is absolutely essential. So performance is not everything. When it comes to investments, it's also risk profile. You may have great performance, but once in a while, you'll be suffering minus 60% return. So for that reason, it's important to, yes, try to educate yourself, and yes, talk to a professional. It never hurts. It actually always helps.
This question almost brings things back to the simple conversation of comparing investments in general and comparing different mutual funds, comparing different investment products. And the segregated fund is just a level on top because it includes that insurance contract within it. So it's not comparable in that sense because you have to understand the value of having that extra additional protection there.
Yeah, I agree with that. It's really... It's a complex issue. And when you're comparing things, you have to take into consideration risk, returns, additional guarantees. And well, my favorite point about all that yes, you can have all these guarantees and you can have all that package and still have a decent performance of the investment. Not anyhow worse than it's expected to be.
Right. I've got a question about cascading wealth. So you said that for cascading wealth, I have to buy a life insurance policy on the adult child, but can I get insurance on younger children?
Yes, you can. Yes, you can. It would work, in fact, even better because we all know the younger the individual, the lower the rate. And if we're talking about permanent insurance policy, this rate remains for the rest of the life of the individual. So the younger you buy the policy, the more cost-effective vehicle it becomes. And since you are the owner, you can really control every aspect of the policy, including beneficiaries. If you're buying a policy on a child and later on child grows up, gets married, gets children, you can put those children as beneficiaries and achieve full cascading wealth. So yes, it's a good point.
Okay. And I just have one more. Is there any extra cost to reset a principal guarantee on segregated funds?
Yes, it is. By and large, it's about 0.1% of additional fee included. Well, it's not much. It's worse that because market could jump sometimes double digits. And if you use the reset guarantee feature, it means that this double digit growth is actually added to your principal, and your principal becomes that appreciated value from going forward. And if market drops, if this reverse process doesn't happen, your principal still stays on that high level going forward.
All right. I think that's all for my questions. Janet, do you have any more?
Yeah, I mean, I really liked the fact that with the funds that there's no time delay. This idea that the insurance has no time delay. I just wondered if you could speak to that a little bit, like just that usually an estate takes, what, 6 months, a year? and this insurance policy can kick in almost immediately. It's
Yes, it's in fact, it's quite a rewarding feeling to deliver this check at the time when everybody is trying to calm things down, find the solutions, deal with funeral home. Literally, segregated funds portfolio is not part of the estate.
right.
And it means that the state itself goes to court, and it is being probated. It's being measured against the will to make sure that there is no, say, future version of will, and there are no people who can present substantial details that change everything. All this is applicable to the estate. Segregated fund portfolio is not the estate. So it only deals with insurance company and the beneficiary. Insurance company gets death certificate, they cut the check to a beneficiary, it's being delivered anywhere between 7 and 10 days. It's just that simple. Though, if I can elaborate a little bit more, some people get overexcited and say, oh, so that there are no taxes there, even if it was a RIF. Well, don't play these games with CRA. They're not really that optimistic. No, there are taxes. You cannot bypass taxes, but probate fees, estate delays, yes, for sure.
And then I had a question actually, or maybe an observation for Candice, and the online giving piece that you were presenting, even just the trends in terms of fund, like I know for our charity, for example, that we have an amazing list of very dedicated donors who've been with us for a long time, and I'm always immensely honored that they continue to give at the rates that they do. And I've seen this sort of loyalty feature with us, but growing the basis of donation. You can get the one-time gifts, like somebody who responds to an immediate concern or something like that. So that's how I would sort of characterize the online giving. But I would see our work as very reflective of the giving trends and how that works. And I don't know if you wanted to speak to that a little bit more, because I see online giving becoming more and more of a thing, and it seems to be very transactional, like I want to solve this problem, so I'll give this money. It doesn't seem to have that same loyalty factor.
Sure, that's exactly what we see is a lot of reactionary online giving. It's for certain causes or certain immediacy that's needed out there. So to make it a little bit more and one step beyond just a simple one-time gift, people do need to explore a strategic philanthropy plan for their overall estate. It's more than just like, it's great that people will give based on the compassion that they have and the causes they believe in,
Yeah.
but to really take advantage of making sure your estate benefits from it and your current tax situation benefits from it, you should really be donating more efficiently in that sense. So online can also be a matter of donating appreciated securities as well. It's all of a digital front, and Canada Helps is a great organization to facilitate that online giving. Of course, you have extreme fans that will not give away their old habits of writing a check and to be doing mail-in campaigns and things like that. But
Yeah.
where we can actually help out more, we want to do that. That's the purpose of why Vlad and I are so deeply involved and passionate about the philanthropy part of investments.
I love this idea of strategic philanthropy. I think that if everybody can take that sense into this and having their own strategy and being able to implement it, and even doing that with their estate, it really is quite it's almost exciting. Whereas I don't know how everybody else feels about estate planning, but it's a little bit, oh, I don't really want to talk about my death. But but this idea that you could actually be taking your vision and putting it into your estate planning really actually does get me excited. And certainly going back to the previous webinar and what we talked about, this directed funds, that you could do that now and actually start having it flow through. So either the cascading wealth or just even thinking through all of these different tools that you're giving us, it's really it actually has me very excited, and I get to benefit because we get to do a practice run, and I hear a lot of this beforehand. But every time I hear you talk about it and the passion that you bring to it, it's just phenomenal, and it has me thinking about all different kinds of ideas. So, yeah, I just wanted to mention that.
Yes, no, it's wonderful. I mean, let's have your strategies work for you now, for you to witness and see how you can help the charities, and the charities will then be able to plan better as well themselves.
Yeah.
So many times the charities don't even know that they're written in a will, or they're not involved at all, and they should be. I think people shouldn't hesitate to talk to the charities that they're going to be supporting, and that way you can have much more better planning at Wildlands League, and to know how to use the funds.
Yeah, it's so true. I think that, and some people may not know this, but in terms of how we fund an organization like Wildlands League, there's foundation grants and things that have very, very specific details in them, deliverables, etc. But it is the gift of individuals and major donors and long-term donors and people who have a strategic plan for their estate that really help us be able to do the visionary kinds of pieces that we need to do and move the yardsticks down the field in a way that is more strategic, because it gives us some of that flexibility and that ability to react and move in a way that maybe a grant wouldn't, because it's very prescripted. But this allows you to be more effective and have more investment into a long-term plan. So yeah, absolutely.
I think that's all the time we have for today.
Okay.
I wanted to thank everyone for joining us, and Vlad and Candice for their expertise. And I hope you'll all join us on October 20th for our final session on wills and estate pitfalls. Thank you so much for being here.
Thanks, everybody.
Thank you.
Thank you.